Let's see if that did it. Hopefully. Should be kicking on here. We'll wait just one more minute. Good morning, everybody. We'll start in just a second here. I'm not used to this event link for going live, which added an extra couple minute delay here. All right, it's almost spring here in North Carolina. We have 60-degree weather the next couple of days, which is extremely odd. All the bulbs that I planted for the winter are popping up now way too early. But I'll take it. It's nice and warm. Feels like spring out there. All right, feel free to post your questions. I'll get through them as I can. And again, ideally the questions are related to being a trader, psychology, trading game plans, trading theory, pattern recognition, not necessarily what do you think about this chart? Because I do that all the time, 5 days a week. So this will be more bigger picture. Chattanooga, I love Chattanooga. Only been there once, but definitely a big fan. Appreciate everybody posting where you're from. Nice to see everyone from around the world. So first question is about long-term trading versus short-term trading. I know you're a day trader, but for more long-term holders, how do you feel about the MJ sector, specifically US versus Canada? So again, that's something that I talk about in every daily video. For me, the broader market is the most important factor right now, short term. We know we have a lot of headlines leading to a bit of fear and a bit of pullback. So the question is, are the bulls going to buy this dip on this pullback as they always have been over the last year plus? And we're going to be watching the weekly uptrend. So again, it's just a very clear if-then scenario. And that's how I keep emotionally detached from results of what's going to happen. If-then. If the S&P 500 keeps its weekly uptrend, then I'm looking to buy the dip. It's a very simple statement, and that keeps it nice and clear. Otherwise, I'm going to be constantly questioning myself every single day. Should I be buying the dip? Is there weakness? I don't have to constantly be going through that because if the S&P 500 is a weekly uptrend, then I'm looking for bulls to buy the dip. So as long as that is the case, market bulls have long-term control. When that is not the case, and when the weekly uptrend is lost, that's when things get a little bit more tricky and a little bit more difficult as a technical analyst. But as long as that is the case, just keep it very simple. There's no reason to overcomplicate things. Honestly, the Netflix documentary, or not a documentary, their series, Pandemic, that just came out, that's something that I would normally watch and be interested in. And I have intentionally not watched that because I do not want it to influence my technical analysis. And I know that it might. With the coronavirus currently going on, it's going to have it's going to strike my emotions. It's going to strike fear. It's going to strike me thinking, this is the big one. This is going to be a big pullback, and I'm going to be looking bearish. So it's something that I am intentionally keeping from watching because, again, just keep it simple. Price levels are the only thing that matters. And in my opinion, I've seen fundamentals detach from reality with stock prices so many times that I know that short-term emotions can lead to detachment of the stock price. So even if 100,000 people in China come down with this virus, if the stock price keeps going up, the stock market, that's the only thing that matters as a trader. And again, we have to distinguish between being a trader. Trader Dan is very different from human Dan. Obviously, I don't want people to get sick and I want everybody to get better, and it's a tragedy for the people that are going through it. But when I'm in Trader Dan mindset, I completely erase that human aspect of things, and the only thing that matters is price levels. So the biggest takeaway for me, for people that learn how to trade, people that start trading, they want to know why. Why is this happening? Why are we going up? Why are we going down? Why is the least important factor for me? I don't care why. I just care, is it going up or is it going down? And the price levels are helping me dictate and determine which direction we are going. And the price levels guiding our trends are the most important. All right, a slew of questions. Thanks everybody for posting them here. I'll scroll through as I can. Don't want to make sure I don't skip any. At the end of this video, we will, once I stop the live stream, we'll have everybody comment that wants to enter a chance to win a free course, and we'll give away 5 or 10 free courses. So I will message you. I will choose randomly people that comment on this video, not in the YouTube chat, but on the actual video itself. You comment there, and I will randomly pick people for a course, and I'll be in touch with you all. Are there things you do outside of trading to help with discipline so that you can be a better disciplined while trading? So obviously discipline is one of the biggest factors for trading. We have to stick to our stop losses because, again, the last thing we want to be doing is having a great week and giving all of those gains back on one bad trade because we didn't have discipline in that trade. And that's something that we're always going to have to be struggling with. We're never completely out of the woods. I can have a 6-month span where I do everything perfectly, and then I'll have a slip up. I'll still have 9.5 years in, I will still have a slip up where that loss got bigger than I wanted it to get. And it's just back to the drawing board in terms of, okay, that's a little bit of a reset. I've made that little mistake again, and I'm not going to make that mistake as long as I can. So it's not necessarily as a trader that I've eliminated all the mistakes that I talk about. It's just putting as much time in between them as possible. We want them to happen as infrequently as possible. But even when you get into a flow and you're really consistent, eventually that flow is broken somehow. And it's usually broken by, again, just one of those little reminder mistakes. So as far as discipline, every aspect of our life, discipline can be involved. So it can be the kind of thing where, if you struggle to limit the amount of drinks you have when you go out, if it's an open bar and you're going to have to be conscious of keeping yourself in check, that tells me that you're going to probably struggle a bit more as a trader. It's going to be a bit more of a hurdle for you. So trading is a lifestyle. It's not just something that is, a little facet of an entire life. We have to embody all of this stuff in our lifestyle. We have to have motivation and discipline in all aspects of life. If someone who has trouble getting out of bed and waking up, it's probably going to be a little bit more difficult for them to have this trading discipline. So honestly, understanding psychology and being able to zoom out of situations and understand emotions and how they're interacting, I would say that every trader should take an intro to psychology course, because when you understand, one of the most interesting classes that I took in college as a business management major was industrial psychology, and that's psychology of the workers and compensation and management and all those things. And when you have a base understanding of how the human brain works, it's a lot easier to build off of that. So, I've posted before about Maslow's hierarchy of need, and I posted our version of the trader's hierarchy of needs. Those are things that I think are a baseline of understanding. And once you have that psychology down, you can recognize areas in yourself, with your ego even. Okay, I need more discipline in this aspect of my life. I need more discipline here. I'm not eating healthy. I'm not drinking enough water. I'm not getting enough sleep. These are all things that we have to do. If I can't hone in and get disciplined about those aspects of my life, there's very little chance that I can do it as a trader. So the baseline, the most important base of the pyramid, is having all of those aspects down, our health, emotional and physical well-being, and then we build off of that. So it definitely takes a zoomed out perspective. I need to take a whole look at my life if I want to be a trader and do this in a disciplined fashion. And starting with healthy habits is a good step. And there's so much information out there on YouTube and with ebooks and with podcasts, just as far as psychology and healthy lifestyles and discipline. And once you get those things down, then trading builds off of them. So that's step number one. If you are, struggling with trading and then you zoom out and say, well, I got 4 hours of sleep last night and I was eating an unhealthy dinner before bed. And these are all things that we have to tackle first before we can look to be a long-term consistent trader. Am I starting to become more aware and complacent about the Feds and their monetary policy to hold up these markets? So for me, it's always been a game that the big boys have control of. And my goal is to not beat the market. I want to ride the coattails of those big boys and pick up the crumbs and my piece of the pie. So I am well aware that those in power and those in charge are going to want the market to go up. And fighting that is not ideal. The market has been going up for the history of forever. We're just coming off of all-time highs. And that's something I really struggle with. I've said publicly many times before that I personally have struggled with trust. I struggle trusting the government and the financial institutions because of the past, because of 2008, because of the history of the government. And my distrust of the government has no basis with stock market history. Because again, the people that consider every single dip a buying opportunity have been right for the entire history of the market. And so that's something that I constantly have to be aware of. Yes, I'm going to play to the downside when there's weakness, but I'm going to be aware that big money wants the markets to go up. And we're seeing it in China right now. So China's about to put an influx of 170 billion into the markets tomorrow when they open up again, just try and stop a dump, essentially is what they're trying to do. So it's not a free market in that regard, because they're not just letting the market do its thing, they're protecting it. So the US is doing that as well with the repo operations and the printing of money. So just being aware, number one, it's a manipulated game. It's not a fair game. We have to understand that, because if we are expecting this game to be fair, it's going to be a huge disappointment. We have to recognize what it is and be able to maneuver within that. So I personally am not just going to blindly buy all dips. I will always have risk management on those trades, but I do know that that is the direction that the powerful people want the market to go, and that is the direction that long-term history has shown. So definitely very aware that there is outside help to keep these markets propped up. Saw another question earlier about buying a bull break and having it eventually or instantly pull back, I should say, and how do I deal with that? So the only way that I'm going to be buying a bull break is, number one, if the preceding trends are bullish. I'm not going to be buying an hour bull break on a daily and weekly downtrend. So I will be buying an hourly bull break on a daily and weekly uptrend. Those longer term prevailing trends are extremely important for me. So I will buy a breakout if the shorter term timeframes are not overextended as well. So there's, you can't just say, I'll buy when 9,400 breaks, just looking at Bitcoin. Because if we get there with 8 green hours in a row and an hourly RSI of 72, it's a way different scenario than if we stair step up over 12 hours and the hourly RSI is 60. So not all breaks are created equal. And if we are in a nice tight range, that's why I like equilibriums, the tighter the better, because there's usually more follow through. And when you break one resistance level, if they're really tight, you're going to break multiple resistance levels at the same time and get that follow through and confidence. But if I do buy a bull break with a market order and it starts pulling back, I will have a time frame for my plan. I'll say, okay, well, I will stay in this trade as long as we're in a 5-minute uptrend, even though we're pulling back initially. And if we lose that 5-minute uptrend instantly, I will exit right away. Why will I exit right away? Because the trade is not going according to plan. What I anticipated to happen is not happening, and I will always want to go back to all cash instantly when that happens, and then just reassess the situation. Because if it's not going to go up and follow through on the breakout, I don't want to be in that trade, because my trade entry was specifically based on the expectation that we would see follow through on that bull break. So being very quick to cut that loss is going to save you from then being a bag holder And it's the shorter term time frame trend that will be my guide. 5-minute higher lows as a short term example. What are the differences in my trading setups and strategies when using options versus equity? Honestly, I've traded options so significantly less since my capital has increased significantly enough that common shares are what I'm trading. And that's just preference for me. I have historical data that I can look back at and say, okay, my results are better trading common shares than they are trading options. Options are very high risk, high reward, and they're so high risk, high reward because they're harder, in my opinion. You have a whole different aspect of a factor, time. So with common shares, I think $100 support's going to hold, and I think we're going to go up to 120 in the next month. And I can just patiently wait. And if we trade sideways for a week, that doesn't matter. As long as we don't break my stop level, I can patiently wait for that trade to play out. Now, if I'm in an options trade in that same exact scenario, I can be right about the direction, but if I'm wrong on the timing, I lose. And I really don't like that. If I'm going to be right on direction, I want to have that be a win. So in that option scenario, if we trade sideways for a week, the option premium is going to be eroded and my position is going to lose money from sideways trading. So that's, again, why it's so high risk, high reward. And I love eliminating that equation. I don't care how long a trade takes to play out. If my stop level is not hit, I'm sticking to my trade game plan. And that's why common shares, in my opinion, are so much easier for me. Other people focus and put all their time and effort in options, and they excel at options. So it's just where you put your focus and what resonates with you as a trader and as an individual. A lot of people like to go to options because it is a way to grow your account quickly. You know, they see those big gains of 20% in a day, 60% in a day. But on the flip side of the coin, you can drop that fast as well. So I would say a lot of people get this part of my answers confused. They say, are options a good asset for low capital accounts? The answer is yes, but the commonality between low capital accounts is most often that's newer traders. You do not want to be trading options as a newer trader. I traded options 4 years into technical analysis when I was extremely comfortable with charts and I lost money. And that's because it's a different animal than just trading common shares. There's a lot of different moving parts and different aspects to things. So are options good for smaller accounts? Yes. Are options good for newer traders? No. So if you have experience and you have a smaller account and you've been practicing with options for months, again, I didn't practice and I lost. It's just a very clear example from my history that hopefully others can learn from. But options are an extremely difficult animal, and I would suggest getting extremely comfortable with common shares, technical analysis, paper trading options, watching how they move relative to the underlying asset's price, and then slowly dipping your feet into options trading. What time delay is there between breaking news and reaction from broader market moves? Very, very little time delay. Honestly, it's usually instantaneous. With the broader market, it's instantaneous. Sometimes you can see a little bit of a delay. For example, if you have, it's what the video I talked about correlations, you have direct correlation, inverse correlation, and indirect correlation. So an indirect correlation is when you're going to see a little bit of a delay in a market reaction, where you have the underlying reaction. Let's say you have, I'm trying to think of an example off the top of my head. Let's say you have bad news for Apple. And Apple drops. And then as Apple's dropping, the tech sector is dropping. And then as the tech sector is dropping, the S&P 500 is dropping. Those are going to all happen fairly instantaneous. But you could then look at the financial sector and say, well, is the financial sector going down a little bit because SPY is going down, because the tech sector is going down, because Apple's going down? And the answer is yes. So oftentimes you can find a little bit of a laggard move in some of the names that aren't necessarily directly impacted by whatever that news is, but they are indirectly impacted from it. And a recent example would be Bitcoin. I noticed the correlation with Bitcoin and gold inverse to the markets with the Iran news that we had recently. It was a very brief correlation, but it was there, and it was more of a delayed reaction. So we would have news of a missile bombing a base in Iraq, a US base. We would have markets instantly dump and gold instantly go up. They were directly reacting to that headline. And then slowly after, maybe it's 10 minutes, 20 minutes, we start to see Bitcoin volume coming in and the bulls starting to react to that. And so that is what I would call an indirect correlation. It's reacting to the same things, just a little bit more slowly And another factor of that is the high frequency traders and the bots. You don't have these bots that are trading across all these markets. You have the bots that are reacting to the headlines. They read the headline as soon as it comes out and they make price action movement based on that instantaneously. But because Bitcoin is not traded on the big stock exchange, it doesn't have that direct link to those high frequency trading bots. So it's going to react to the human traders just a little bit more delayed. How long did it take for me to become consistent at trading? Any advice for someone who's trading for 1.5 years and looking for consistency? So obviously this answer is difficult because, if you're trading an hour every day for your first year and a half, it's very different than if you're trading 5 hours a day for your first year and a half. So that's a little bit of an unknown factor for me. I was not all in trading when I started. I was in college, number one. So college was my priority. And in all my free time, I was learning, I was reading, and I was watching how the markets reacted to things. And I would say it took 4 to 5 years before I was confident in saying, I can do this for the rest of my life. And that was, again, 5 years to reach that point. So that was not 5 years every day trading and every day learning. I spent maybe a solid 4 or 5 months where I said, okay, my job for the next 5 months is full-time every day learning technical analysis and trading. And I put in that solid chunk of time, and that was my base of understanding and education that I then built off of. But after that, I went around and I traveled and I road tripped and stuff. So there would be periods where I wasn't really trading for 4 or 5 months. So it wasn't a solid 4 years in a row, but that's how long it took me before I had that confidence. And again, it's just continuing to prove things to yourself, because you can have success for 1 year in a certain market cycle, and then that market cycle shifts and you have to relearn again. If you're in a bull market for a year and you're trading in that bull market, you develop habits, you develop patterns. You say, okay, bulls buy hourly oversold conditions. And then you switch to that bear market and suddenly hourly oversold dips are not getting bought and you're losing money trying to do the same trades that you did in a bull market. So that's the other factor. If you have one market cycle that's lasting a certain amount of time and that's the only market cycle you're exposed to, it's going to be a little bit less ideal than if you're having exposure to all kinds of market cycles. And unfortunately for those who had to learn the hard way, but fortunately for getting the lessons out of the way, the cryptocurrency space, the marijuana sector, they have all gone through huge bull and bear markets in the last few years. So that has helped people be able to experience both. Now the S&P 500, for those that are only trading the S&P 500 in the last, let's say, year and change, they're only knowing significant strength by the bulls and buying of the dip. And you have to go back to the dump at the end of 2018 and some other previous dumps, obviously 2008, which I didn't even experience. I was not trading during that point in time. So I know while I have a ton of experience in bull and bear markets, I have not experienced an extreme bear market. I was not there for the tech sector bubble. I was not there for 2008, but I'm hoping that the lessons that I have learned in the marijuana penny stock boom and bust and the Canadian MJ boom and bust and crypto boom and bust, that I can apply that when we do see big busts in broader markets, which again have been so few and far between over the last decade. Will we ever offer lifetime memberships for the Chart Guys? One thing that I don't like about that is then feeling obligated. So I have problems with long-term commitments, and I love having an annual where I can say, okay, I'm in this, I'm all into the Chart Guys for another year, but I can't say I'm all into the Chart Guys 8 years from now. And if you're going to get your full value, then I would feel like I would be leaving some people hanging. It's added pressure on me to continue doing this for the rest of my life, lifetime membership, where I have no idea where I will be in 5 years or what will be going on in the world. So the reason we don't have lifetime memberships is my lack of commitment, which is also part of the reason I don't have a significant long-term portfolio. I'm currently in a GLD trade for gold that I've been in for a month and a half. That's probably the longest position I have held, aside from my no-touch crypto position. It's the longest position I've held in a very long time. And that's, again, something that I'm constantly trying to work on. My ability to look further into the future And when someone asks me, hey, do you want to go on this trip or do this thing in 6 months? My answer is always, we could be dead in 6 months. I can't think that far ahead. And that's part of my very short-term here and now mindset, which does bleed over into how I trade. And I am working on trying to fix that. And again, it's just another example of what I talked about first, how aspects of being a trader bleed into your entire lifestyle. And if I want to correct my ability to look long-term and hold multiple year positions in stocks or assets, I have to fix part of my psychology of my broader world view and life view. So that's something that I am constantly trying to work on as well. Minimum amount to start with day trading to make 1,000 average a month. So you have to have a bare minimum of $25,000 in the US for being a pattern day trader. So that is your bare minimum benchmark level, 25,000. And if you dip below it, they're going to say, hey, you can't day trade until you're back above 25,000. But think about it in terms of percentages. The S&P 500 historically averages 10%. My goal is to beat the S&P 500 because otherwise, if I'm not beating the S&P 500, my answer is, why am I trading when I could just have my money sit there and I could be doing better? So beating the S&P 500 is the most important thing for me, which means if you want $1,000 a month, and if you're going to have $100,000, and that's 1% a month, that's beating the S&P 500. So again, you can't answer that question because market cycles are so different. You could make, with $25,000, you could make $1,000 a month easily in 2017 marijuana stocks, in 2017 crypto. And that's no longer the case in the marijuana sector. So the market cycles and the opportunity to present themselves are so fluctuating that to have just this consistent number of, I'm going to make this every month for the next few years, you can't do that. I make a ton of money in a few months and I make a little money in the rest of the months because I know when to push the gas pedal and seize opportunity when it's there, and I know when to pump the brake and to back off when it's not there. So over time, my averages are going to be smoothed out. But if you looked at it zoomed in with a magnifying glass, you're going to see huge big bull months and then little bull months and then little bear months and little bull months and then a big bull month. And it's all based on the market cycles. So consistency is obviously important, but also knowing when to slam opportunity and back off when that opportunity is no longer there is also extremely important as well. So having an average goal is a good thing to have. You definitely want to have that, again, discipline to try and reach that goal, but just be aware that every couple of months, things can be extremely different that allow for significant fluctuations, and whether you're significantly beating that 1,000 goal easily or whether it's a struggle to get to. Best sources for real-time news. So I like Fidelity, Active Trader Pro. They give me any position I have on my screen, which is about 20, 25 tickers. They give me a little pop-up as soon as that news comes out. And then, of course, the chat room. We have Arlene, who is a chat room member who is just an absolute stud, posting her news throughout the day, every morning, and then as any major news headlines take place. We have a bunch of other people who post news as well. So knowing that there are hundreds of people all using their own individual sources, it really has just an all-encompassing view of a ton of different sources to allow that news to be read as soon as possible. So I would say having, again, a team of traders is the way to do it. This is not an individual game. You can do it as an individual. It's harder, in my opinion. Why would you not want to have a team game where there's people on your side helping each other out? That's the way to do it in this market, in my opinion. So the more eyes, the better in terms of having a ton of sources for news. Do I think it would have helped in my day trade? Do I think it would have helped being a day trader? Bummer. That question just got buried. My bar just jumped down real quick. I'm not going to be able to refine that. Do I feel certain patterns are more common in a bull versus bear market? Seems like cup and handles are more bull. Yeah, absolutely. So a cup and handle is a continuation pattern. You'll see it on Twitter. Again, it's the most misdiagnosed pattern, in my opinion, that I see, because people will try and put a cup and handle in a downtrend. It's a continuation pattern. You have to be in an uptrend for a continuation pattern to get follow through. Same thing as an inverse head and shoulders. That's a reversal pattern. So putting an inverse head and shoulders at the top of an uptrend is not where it goes. You're not going to be looking for a bullish reversal pattern at the top of an uptrend. So equilibrium, hands down, is the most common pattern I see in markets across all sectors, all time frames, all markets. It's a break into it's a spike in volatility and a break into a new trading range, and then it is price discovery, tightening range into a break. That is hands down the most common pattern. But other than that, cup and handle is probably the least common pattern. And then there's everything else in between, and market cycle is going to dictate which patterns have better follow through. And some market cycles are choppy and we don't have clarity, and those are the ones that we want to be avoiding and staying away from. How do I explain trading to someone with zero knowledge who says, isn't it just gambling? Trading's gambling, without a doubt. We need to be real with ourselves, but it's gambling with an edge in our favor. If I can gamble and have a slight edge in my favor, over a 50% chance, and I can limit my risk and allow my reward to go a bit more than my risk, that's when we start acting as the house. I want to be the house, the casino in my trading. I want to have that slight edge. I'm going to lose plenty along the way, but my wins are going to be more than my losses long term. And otherwise, if we are on the other side of things and we're not the house, as not the casino, we're going to be the trader, or I should say the gambler. We're going to be winning enough to keep us sticking around, but long term we're going to be losing, because whether we don't have discipline or stop losses, and whether, casinos want you in their casino as long as possible, because if you have a big win, statistically speaking, the odds favor that you're going to give it back. That's the way that it's rigged for the casino and the house. That's how they stay in business. So they want you staying there. They want you to keep playing the games to eventually give it back. So that's where we as traders can know. We can make conscious decisions and say, okay, I just had a big win. I'm going to stop trading for now and clear my head. I'm going to wait for a better opportunity. And that's where the discipline comes into play. If I have a big win playing blackjack and I choose to leave the casino and keep those wins and then come back and trade with a smaller amount, I'm not going to give all of those wins back. And another example is counting cards in blackjack, which is frowned upon by the casinos because that's how you take their edge away. You then take the edge. If you can put a small percentage chance in your favor on every blackjack hand that you play, again, you're going to lose a ton, but over the long run, you're going to end up being a winner. So yes, it's gambling, but it's gambling where you can have the odds slightly in your favor to come out on top in the long run, and that's where trade game plans and discipline all come into play. Do you need an economics major? No, absolutely not. Honestly, very little of what I learned in finance and economics have I applied to trading. Yes, it helps to know the broader concepts. It helps to know what's on a balance sheet. I don't read balance sheets and make any trading decisions based off of them, but I know what those numbers mean. So it helps. It can only help. Would I say that you should go get a degree in economics or finance to be a trader? Absolutely not. The internet has tons of free information and YouTube and articles, and there's just so many ways to train yourself, which is essentially how I started trading. In my room, sleeping on my bed on my floor in college, on my laptop, getting some direction from some very helpful people by pointing me, saying, hey, you should read about this, and then self-guided education. Because again, the information is all there. It's just very overwhelming with how much information there is, and having someone who has experience to be able to hone in on what is most important to focus on is obviously very beneficial. What shampoo do I recommend? That'll be a different video. What trading strategies don't work for me? So I'm a better long trader than I am a short trader because I've been trading more in bullish markets than I have in bear markets. So I excel at playing euphoria breakout markets, and my strength in those markets, anybody can make money in a euphoria market. My strength is not giving my gains back. So that's my biggest strength, but I also don't make as much as I could on the way down by shorting. So not that shorting doesn't work for me, it's just one of my weaknesses that I could get better at. Long-term trading, as I talked about, my fear of commitment, that is a long-term strategy that doesn't work well for me. I tried swing trading more in 2019 than I have in the past, and my results tell me, yeah, you could continue to improve on it, but you're going to do better if you keep day trading. So then in 2020 here, I've decided, all right, I'm just going to stick with what works for me because clearly my results are showing me that day trading is better than swing trading for me and my style. So I would say these are all areas, again, not necessarily that don't work for me. They just work less well. They don't work as well as day trading. So you've done oversold bounces for over a year and you're realizing it's not your thing. Absolutely. Stop trading oversold bounces. You have data that you can go back and look at and say, is this working or is it not working? And after you give it a certain number of attempts, then absolutely cut it. Cut the weaknesses and focus on your strengths, because oversold bounces are very difficult and some people cannot trade them well. I don't know why it has become one of my edges as a trader, but it has, so I embrace it. But I'm well aware that it is not for everybody, and especially not for newer traders. Very difficult, because one of the aspects of oversold bounces is you are staring fear directly in the eyes when that trade is taking place, because the price is dumping rapidly and you are saying, I think it's going to go in the other direction soon. And so that requires a whole lot of psychological preparation on top of just the technical aspects of trade management. Any advice for an aspiring full-time trader considering transitioning from 9 to 5 after finding success trading part-time? The biggest factor I would say, and this is something that I will openly talk about with the chart guys, is having a secondary source of income is invaluable as a trader. If you are only relying on your trading income to live off of, the amount of emotional pressure and stress that you're going to feel is going to be huge, especially if you're not just trading for yourself. If you have other people dependent on you, if you have a mortgage, these are all huge factors that are going to impact your psychological and emotional well-being. Without a doubt, when the Chart Guys started 5.5 years ago, I saw a major shift in my trading, because I was then no longer pulling my trading profits to live off of. I was leaving all of my trading profits. I was able to trade with larger capital because I wasn't constantly draining it to live off of, and I was able to take bigger risks. I mean, I smashed the cryptocurrency space in 2017. If I did not have a secondary income, there is no chance I would have traded it even half as aggressively as I did. I traded it that aggressively because I knew if I lose all of this money, I still will have enough income that I can live off of, and it'll be a big step back, and I will have to struggle and work really hard to regain it, but I will land on my feet. And if I did not have that secondary income, I would not have taken that trading opportunity. So I would say, a 9 to 5, obviously it's very hard to trade with that, but do everything you can. This is why I think entrepreneurship, we just created in the Chart Guys recently an entrepreneurial channel to talk about these things, because entrepreneurship is a mindset that you are not taught with how current society and schooling is structured, but it's contagious. And I lived with an entrepreneur for a few years, and next thing you know, the Chart Guys is a thing, and I'm getting into all aspects of business that I never would have gotten into. So having an entrepreneurial mindset and having as many streams of income as you can for security, for psychological well-being, to not have a burden of stress while you are trading, is essential. So I get very nervous when people tell me I'm quitting my job to become a full-time trader. That to me is scary. And I know right now that if you gave me a family and you took away any secondary outside income that I have and you say, okay, here's trading now, keep doing it, I would say very likely I am not going to trade as well in that scenario as I do right now. And because of all of the underlying factors, with the most commonality between them being the psychological burden and stress of that situation. So don't paint yourself into a corner where you are relying on trading to live, because then things can get very stressful, and then it just compounds itself with a negative mindset and stress, and then you make a bad trade, and then it keeps just a cycle of recycling fear. So I would say have some kind of outside income, prove to yourself over a consistent period of time, long-term, multiple years, that you can do this consistently, Or, if it all depends on your situation. When I was able to say, okay, I'm going all in on this trading thing, I was really young. I knew that if I fell flat on my face, I could just get a 9 to 5 like everybody else and bail myself out. I had nobody relying on me. It was only myself. And that is a very different psychological standpoint to be in. So it seems I have a keen sense on when an equilibrium is going to break. Are there probabilities purely technical, or is it more of a Zen awareness you have cultivated over time? So definitely it is experience. So when you have seen, at this point I've seen literally tens of thousands of equilibriums play out on the 5-minute up to the monthly time frame over the last 9.5 years. And when you see something so many times, you have this backlog in your mind, a library that you can say, okay, I've seen this plenty of times. I know that this many candles have tightened this equilibrium, and I know that we can only see another 6 candles or so before we're going to have to break in one direction or the other. So that allows me to be able to say, we are likely going to see a break within the next, if it's the daily chart, within the next 6 days, let's say. And that's experience. So the more you see these charts and the more you see things play out, the more you recognize them and have recall as to how it has played out in the past. And that is where I have always had a good memory, and schooling was easy for me because of that memory. I could just memorize stuff for a test and regurgitate it on the test and do well. And without a doubt, that memory has served me in trading because of that pattern recall. And I can say, this chart looks just like this setup that happened a week ago, or this chart looks like that setup that played out, however long ago. And the more those experiences build up on each other, the more comfortable you get with them. And that's when you will be able to set those most likely scenarios on when things are likely to happen in tightening ranges. Can MJ still rally with both Bernie winning in the primaries and the markets pulling back? So yes, in my opinion, the marijuana sector will be a safe haven sector if we see Bernie Sanders gain ground and the market react bearishly. Because of the catalyst that the MJ sector would see being so much larger and money flowing into the sector being large enough to offset any broader market fear, I do believe it will be a safe haven sector. How do I choose which tickers to focus on with so much action going on? I have a core, and everybody needs a core of tickers that you are comfortable trading with, and those are your go-to. You know them like the back of your hand, whether it's 2 names or 6 names or 10 names, depends on the individual. Some people can have way more open positions and way more, let's just start with that. They can have way more open positions than I have. I like being in maybe 2 trades max, and I trade with people that can have 8 positions open that they are actively managing. That blows my mind. Their mind works differently. They're comfortable doing it. They have the experience. They're different. Traders are so different from one to the next with so many different styles, but no style is right or wrong. As long as it works for you, then it works. So I like to have my core of 25 tickers that I'm watching on my Fidelity Active Trader Pro platform every day. And then there's flavors of the month. And BYND has been a recent flavor of the month, and LK and SPCE. And these are names that are highly volatile. They don't have a ton of trading history. And most notably, a lot of them are hitting blue sky breakouts, SPCE. And an example would be Tesla. So obviously Tesla's getting a ton of attention over the last 6 months. 6 months ago, I was not trading Tesla actively at all. I would trade it maybe a couple times a month, and I didn't know the ticker. Once this action started in the last 2 months, I have started to trade Tesla sometimes 10 times plus a day, and I get very comfortable with how it trades and how it reacts. For example, just the first 15 minutes. I know that watching Tesla in the first 15 minutes of the trading day, that we very often get a solid, quick move in one direction and completely turn around into the other direction. So I have got accustomed to trading that first 15 minutes and doing well based on what I have observed in the past. So it's constantly changing. I always have the S&P 500, the tech sector, the financial sector as my backbone of having my broader view on the market. And then depending on the market cycles of the individual names and the opportunity that they're presenting themselves, that determines which names I'm looking at. So Roku was a name that I was looking at very often. I've been looking at it less and less recently, and that's because it has a bit of a tightening pattern And once that tightening pattern breaks, I'm sure it'll be back on the menu as a potential trading vehicle every day to be looking at. What EMA timeframes do I look at when trading? On the hourly and under, I look at the 4 and 8 exponential moving averages. I look at, let's just simplify. I look at the 4 and the 8 on the 5-minute and the hourly on my Fidelity screen. I look at the 12 and the 26 on TradingView, and I'll cycle through all timeframes on that. And I like the 2-minute time frame for the 12 and 26 period moving average. And let's see if I can come up with an example real quick of that. But the S&P 500 on Friday, the 2-minute time frame was a great guide for weakness, and it kept me from looking to buy any dips. So here's just an example. Let's shrink my face real quick. So the S&P 500, here's the start of Friday, and here is the first 2.5 hours of trading. Every single bounce is rejecting from the 12 and 26 period exponential moving average, notably the 12 here, and that tells me don't go long if we cannot get over this level. Every single bounce is a bearish entry opportunity because the bulls are proving absolutely nothing to us by getting over these levels. We then eventually got a bull move into the end of the day. It didn't last very long, but I did trade this bull break. And I was trading bearish before that, and as soon as we got over this level, and actually I might be a little bit premature, I traded this bull break. So I take that back. It was a falling wedge that I traded the bull break of. But the bottom line is it can keep us from being too early. I'm not going to enter as long. And then again, it goes back to that if-then scenario. If the current price is under the 12 period exponential moving average on the 2-minute time frame, then I'm not looking to play bullish because the bulls have proven absolutely nothing, and we're just continuing the trend of rejecting from resistance and pulling back. So I have been loving the 12 and 26 period exponential moving average from cryptocurrency space, where I first started using it in 2017, and then taking it and applying it to stocks on all time frames in 2018 and 2000 up to now. And I have found it to be a great visual guide for me for short-term targets, for looking for support levels, for higher lows in an uptrend, for noticing shifts. I mean, you can look at SPY on the daily time frame. Look at the daily 12 period exponential support. Yes, we did close under it one time here, but we just closed under it, and then we back tested and failed to get back over it and dropped back down. So that is a very notable shift for me, and there's a ton of names that were very similar to this, holding the daily 12 period exponential support for months and then finally losing it. So you want a clear pivot and a clear shift in momentum. That's it right there, and we're seeing it on many individual names across the board. Here's XLF. So XLF held it for months and months. Again, we did dip below it once and then quickly regained it. And now that we've traded sideways and lost it and rejected from it, that's a market shift for me. And now the question is, zooming out, can we form a weekly higher low as a result of that daily shift that has taken place? Interested in my story with the Occupy movement? That's a story for another day. I did do a series at the end of cryptocurrency videos where I went through it very in depth, but that was back in 2018. Crypto people are usually more interested in that. So for anybody looking to put long-term money in the market, the first factor is how long. How long are you going to be willing to put it in? Because if you're only looking at 1 year, your risk is way higher than if you're looking at 10 years. Why is that the case? Historical evidence. The S&P 500 has gone up in the history of forever, and it goes up by 10% a year on average. So that is historically what we have to go off of. So if you're looking, the question I'm responding to is someone saying, hey, my sister just got a bunch of money and wants to put it in the market. If she's looking 10 plus years out, the market's the place to be. And if you look back and say, okay, well, if I just entered a little bit of a position every time the S&P 500 got oversold on the daily time frame, I'd be doing really well right now. So I never look to enter a full position at once. You want to be scaling in, ideally. You don't want to just try and nail the bottom. So if you had I'm going to be doing this myself. I have an IRA and I have some cash there. I have a GLD position, and I now have some cash from 2019 contribution that I'm going to be looking to apply to buying this market dip as long as the S&P 500 is in a weekly uptrend. So I'm not going to try and nail the bottom. I'm going to be looking, if the daily RSI hits oversold on SPY, you better believe I'm going to allocate a chunk, maybe a third of my capital to S&P 500 entry. If we see another leg down, I will add another third. Another leg down, I'll add another third. And again, that's just a long-term mindset because I'm not looking at that position until another decade plus out. And I have that same mindset with the crypto position I have. It's a no-touch position, long-term. As long as we are not in a monthly downtrend, I will hold that position for years, many years. So it's having time frame as the most important question to answer. And then after that comes risk tolerance. What's your time frame? What is your risk tolerance? If your risk tolerance is low, you're looking at mutual funds, or you're looking at some of the other lower volatile instruments. If you're looking at high risk, then you're going to be looking at perhaps leveraged ETFs, although you don't want to hold leveraged ETFs long-term due to time decay, but perhaps something a bit more specific like the tech sector rather than the market as a whole. When you're looking at the market as a whole, you have other sectors to buffer. Maybe the tech sector pulls back, but the financial sector holds on, so the overall market doesn't drop as much. But if you're only exposed to the tech sector, then say Apple has something terrible happen, then you're going to have that position hurt more. So the more honed in and focused you are, an individual name is extremely high risk. An individual sector is less risk, but still high risk. The market as a whole, much less risk, much less reward, always directly correlated with each other. So those are questions that you have to answer with yourself before making any long-term decisions. Cryptocurrency taxes. I use cointracking.info to compile my reports that I send to the IRS to prove, they get my 1099 from Coinbase that says I traded this many dollars, and then I send them that report saying, yes, I traded that many dollars, this is how much profit I had, these are all the trades proving it, and then I cannot stress enough having a competent accountant to help you with your taxes, which if I could go back in time, one thing that I would change with both the Chart Guys taxes and my own personal taxes, 2 years earlier, I would have gotten an accountant. It was not worth the stress, the time, and the headache. I could have put that time into other things that would have resulted in, whatever other avenues. But having someone, and for us, we have a Chart Guys member, Rohit, who has been an absolute blessing in terms of helping us as individuals, as a company, as being a friend, to just give it to us straight. He's very knowledgeable on Canada, US, marijuana stocks, cryptocurrency. He's got he knows everything that's going on. And I can't stress enough how important that is. And he's going to be starting potentially his own thing sometime in the future. So feel free to leave a comment if you want that contact. I will happily give out his contact to anybody because I definitely recommend. The story that I have is in 2019, I was planning on paying the government X dollars for my income. He then said, hey, you can have trader tax status and that will change things for you. He set that up for me and I ended up getting 3 times what I was planning on paying. I got back in a return, which was a massive game changer. So having someone that knows what they're doing, it's not that my other accountant before him was bad. It's just that he didn't have the knowledge of a trader. To have an accountant that is a trader is invaluable. Is there a method to determine how a trader finds their style and matches their personality, time frames for their trading and lifestyle? It's trial and error, and it's data. Compile your data. We have data to go back and look upon. I mean, you can get as in-depth with it as you want. If you go back and look at your data and says, Tuesday is my worst trading day. And who knows why that is? Maybe it's because your kid is home on Tuesdays because they don't have a sports activity. Whatever the reason is, it could say, maybe I just don't trade on Tuesdays. And maybe I focus more on the days that I do better, whether that's a reason because of my outside life having an impact. So long story short, the answer is trial and error, see what works for you. But the only way you're going to see what works for you is by compiling your data and your trading statistics. TraderVue, TraderVue.com is a website that I've never used personally, but others have, and it works for them. And it compiles things, it makes it nice and organized, and it gives them statistics to go off of. If I can go back and look and say, well, I'm losing on my oversold bounces, that means stop trading oversold bounces and focus on maybe equilibriums. And then if you have data that says I'm excelling at equilibriums and they're working for me, focus in on that more. It's all about knowing not only market cycles to know when to pump the gas and pump the brakes, it's knowing what setups to pump the gas and pump the brakes. It's knowing what is going on in your life. So if I'm traveling, I'm pumping the brakes as a trader. Like I said recently, that's an away game for me. Sports teams perform better at home because they have their routine, they're comfortable, it's their locker room, they know this, it's comfort. As soon as they go to an away game, their odds of winning go down a bit. And it's because it's an unknown, it's a break of routine. If there's one thing that farming has taught me, animals love routine. And we are animals. So again, knowing to pump the brakes and knowing when to go strong is very key. If I traded the same way every single day, I would lose money. I have to know when to trade aggressive and conservative based on market cycles, based on life events, and based on what works for me and what doesn't. For me, it doesn't matter whether Bernie wins or Elizabeth Warren wins. They're in the same boat. I'm viewing it as Bernie and Warren, Biden and Trump as the three potential outcomes. So that's how I'm viewing things. If Trump wins, things stay the same, no major changes. If Biden wins, less major changes. If Warren or Bernie wins, some major changes. That's how I'm viewing things. And again, the more information that we get from polls and from results, that's going to shift things in terms of probabilities. What the market is going to be doing for the next 10 months is determining what is the probability of who is going to be president in a year from now. So the more information that we get, the more that probability needle is going to shift in reaction to that information. And again, I don't care about your political opinions. You should not care about my political opinions. The only thing that matters is how is this going to impact the markets? That's it. Listening to music when trading. I listen to music in the morning when I am establishing my game plan and getting pumped for the day and putting the whiteboard and making key levels for members. And then I don't listen to music. I used to, and it's not necessarily, I also used to have CNBC on in the background, and then the repeating commercials made me want to smash my head against the wall. So I stopped. But it depends again on your personality. For me, I trade in silence during the day, but I also have the birds in the background, and I'm looking forward to opening my windows in the spring for that to be more of a thing. But it's the individual. It's whether music helps you get in the zone or music distracts you. And you could have two traders where they're going to say the complete opposite things. TDA has a paper trading platform where you can practice with some options. The Thinkorswim platform. It's never going to be as real money trading, but it's better than nothing. The most important thing about practicing options is watching how the price of the option moves relative to the price of the underlying stock or asset. For me, a generalization in leveraged ETFs, the question is, are 3 times leveraged ETFs too leveraged for swing trading multiple weeks or months? For me, I don't like holding a leveraged ETF for more than a couple weeks. If it's in a prolonged uptrend, then it obviously keeps working, but over multiple months is when that starts to add up. So for me, it's a 2-week time frame. And that's just a clear level to be going off of, where if I'm going to be looking to hold a position more than 2 weeks, like my GLD position, I chose GLD over UGLD because I wanted non-leveraged potential multiple year hold if things go really well with gold. How do you get around trading for small accounts? So options trading, but again, very high risk. Options trading, you can have your funds settle the next day as opposed to settling in multiple days for stocks. And also futures. So I do not trade futures because at this point, I have no reason to change with what I've been doing. It's been working well. It's satisfying all of my needs. If I hit a rut or if I need something new, I will transition to futures. We have futures traders that I trust and know are good traders that say that is the best place to go for small accounts, and I defer to them. And they have the experience trading those futures, and if they say that it is better, if I know a trader that's traded options for a few years and traded futures for a couple years, and they say futures is the way to go, I default to them and say futures for a small account is your best bet. But again, discipline is key because you can blow up your account there just as fast as with options. I do live chats. Question is, can I do live chats more often? I do live chats 4 days a week. So Monday morning and afternoon, Tuesday, Wednesday morning and afternoon, Friday morning. So I'm live all the time. And again, that's with Chart Guys members in our chat room community. So again, what's my winning percentage on my trades, and what is my win or loss size? So again, as to go back to my point with market cycles, in 2017 and 2018, I was able to smash crypto and MJ and see huge gains. So if I look back at my last 3 years, I can say that I'm up maybe 60% a year. And you compare that to the S&P 500, and I'm smashing the S&P 500. You look back at 2019, I didn't beat the S&P 500. I was a bit under it because the S&P 500 has a huge year, and because I was not trading any euphoria markets. So that's that example where my profit line is a huge spike for those 2 years, and it drops a good bit in 2019 and 20 because I'm back to conservative mode. My number one goal is not giving back my profit from those 2 years. And then my number two goal is adding to that profit. So I don't have a consistent winning percentage. If you zoom out, it smooths out. If you zoom in, you're going to see these big spikes. And it's not necessarily big spikes and big dips. It's big spikes and then small little dips, little bear here and there, little losses, but little wins. So it's completely dependent on the market cycle. And I'm sitting here waiting for USMJ and got a little bit excited a bit too early. The SAFE Act fuzzled, that's a new word, fizzled out, didn't do anything. But I am now looking at this election and saying, okay, I am going to smash the USMJ sector if we start to shift towards the probability that a pro-MJ candidate is going to be our president. If that starts to happen, I plan on putting my capital aggressively into play to capitalize on the hype that would follow from that. Just lost my train of thought as to where I was going with that question. Hope I answered it enough. If you have a corporate job, when it's time to risk it and go all in on trading, as I said, multiple years of proven consistency in both types of markets. If you are only proving to yourself that you can trade bullish, that's half the equation. You have to prove to yourself that you can trade bearish as well, or at least not give back any of your gains by trying to trade bullish in a bearish market, which is what a lot of people in crypto and MJ did. You don't have to trade bearish, but if you pull out your capital, wait for the bears to have their run, and then jump back in when it's back for the bulls again, that's all you need to do. But you have to have enough experience in both directions of the market over multiple years, proving to yourself that you can do it. Do I feel technical analysis techniques will always be dynamically changing? Yes, always dynamically changing. And a self-fulfilling prophecy. The more people that learn technical analysis, the more it's going to come into play. As soon as in the cryptocurrency space, we had 5-minute oversold conditions leading to great buying opportunities on our massive bull run in 2017. As soon as I started talking about that in videos that thousands of people are watching and other technical analysts started talking about it, everybody knew just buy when the 5-minute RSI gets oversold. So then the 5-minute RSI doesn't get as oversold because there's more and more people trying to enter that play. So perhaps where the RSI would previously drop to 20, now maybe it's only dropping to 28. So that is a constant shift in the market. And that's why we as traders always have to be agile and adjusting how we trade. If we become stagnant, we are going to, I believe I used an analogy of becoming a rock in a river. The current is going to continually be moving around us, and if we are stuck as a rock, we are going to be missing opportunity and missing the shifts in the market. We need to be agile, moving with the current and recognizing shifts as they do take place. And that's where observation, the art of observation, comes in huge. To say, okay, well, this style of trading is no longer working as well as it used to. In 2018 crypto, I keep going back to crypto as an example because it was so extreme, but we had a period where 4-hour oversold conditions gave huge bounces. And then after a while, they no longer gave huge bounces. And if I traded those 4-hour oversold bounces the same way at the end of 2018 as I did at the start of 2018, I would be giving back a lot of my profit. So again, it's recognizing through observation the shift in the market conditions and knowing to pump the brakes and change my style as opposed to just putting my head down, putting my blinders on and doing the same thing over and over and over again. Do it over and over again as long as it works. But once it stops working and you notice that little shift, it's time to stop, zoom out, reassess the situation, and shift your game plan. Catching up here. Level 2. So I do not use level 2 trading. I used to. I feel level 2 is more important on the less liquid names where a little bit of money has a broader impact. If you look at the level 2 for Apple, there are billions of dollars trading and it's flashing so fast, rapidly moving numbers. I don't get any benefit from that. But if I'm looking at a name like even CGC or Cron or low cap penny stocks or recent IPOs that are less liquid, that have less market makers, that's when it's a factor. And that's when you can see big orders and play based off of them. Many times I will put a buy order just above a big support and I will put a stop loss just under it. Oftentimes, most of the time, I'm gonna get stopped out there with risking a couple pennies. But the time or two that it works are going to offset the times where it doesn't work because there's so little risk there. So I will make trades based off of big orders, and seeing those big orders is easier with level 2. I used it. It was a backbone of my penny stocks trading when I started my career. It was very essential there. Low caps, I would use level 2. Mid caps, it starts to become a little bit less useful. But again, everybody has different styles. I'm sure there's some traders who trade Apple where they use level 2 as a major part of their strategy. I just have found that for me, it is not entirely helpful to do so. And I will use the top bid in the ask spread. So an example of that is recently, within the past couple of days, SPY had a huge bid with a ton of shares on it at a certain level. We came down, we hit that level, and that marked the low of the day. And I did not play off of that level, but I posted in the chat room, I said, huge bid support on SPY. We just bounced right off of it. And then of course, over time, that ended up being the low of the day. So while I did not make any money on that observation, I said to myself, okay, that's a mental note. I'm putting that in my library to recall later. And the next time I see oversold conditions and SPY head to a key big support level, why not risk 10 cents and make an entry based off of that big bid and put my stop just below it? Because if I had done it in this situation, it would have been a huge winner with very little risk. So I will make plays off of orders. You can see the big orders on just the standard level 1 bid and ask quote, but they have to be the top bid or the top ask for you to see them. If you want to be seeing behind the scenes a little bit more, level 2 is definitely useful. What's the best way to identify bubble bursts like crypto in December 2017? The run up. You know it's going to happen. Tesla's going to have a climax top. Do I know where it's going to be? No. Let's look at Tesla real quick. If you run up in extremely overextended conditions, and also psychology and social media is a factor. If everybody is bullish and everybody is talking about it going to the moon and everybody is talking about holding and insane price levels that we haven't reached yet, you know it's time to start being cautious. So with Bitcoin, obviously that happened in a very big way, but you just look at the weekly time frame and it was the massive run up. This is not sustainable in any way, shape, or form. You know a climax top is going to be the end result. And for me, the standard is when I see a climax top shaping up, I say to people, just be cautious. When the top is hit, we're going to pull back 20% very quickly. Now, I could not say that we're going to pull back 80% in cryptocurrency space. I did not anticipate that much of a prolonged downtrend. But you better believe the whole way up, once we got 10,000 and beyond, I just kept saying it's going to end real soon and it's going to end hard and fast. Just be cautious. So when you look at Tesla doing the same thing, you can say, well, yeah, there's fundamentals behind it, but I know it's going to blow off top in the same way because that's how markets and emotions work. Whether it's going to happen at 700 or 900, I don't know. I can't predict that, but I do know that the top will be hit by a huge surge up by everybody that's going to enter a bullish position, entering that bullish position, by there being no more buyers left, and by the scales tilting. So right now, demand is outweighing supply of shares, and we're going to reach a point at a certain price level where the scales go like this. And now supply of shares outweighs demand, and we are going to pull back in Tesla, in my opinion, 20% real quick from that top. Whether real quick's relative, maybe it takes a few weeks to see that kind of pullback, but just be aware that the setup for a climax top is euphoria, is huge gains, is everybody looking in the same direction, and social media showing you that everybody's looking in the same direction. So there's no sign of a blow off top on Tesla, but when I look at this weekly time frame, I know that the most likely way that this bull run is going to stop, whenever it stops, will be with a fast final push up and a fast drop down shortly thereafter. So again, if you want a chance to enter a free course, you're commenting on this actual video, not in the chat. You're making a comment on the YouTube video. And if you want the contact information of the accountant, first need to make sure it's okay with him that I blow up his email, but post in the comments as well. Again, not the chat room on YouTube, the comments. Thanks, Dan Adams. Glad to have you. Have I ever tried trading in the nude? All the time. In Florida, it's the only way to do it. And I've definitely made many videos that you have been watching without pants on. Can the virus crash Bitcoin? No. I don't foresee how that is possible. Oh, if you're talking about a stock virus, I don't foresee that either, but there are others who have way better technical, fundamental understandings of Bitcoin in terms, I was thinking you mean coronavirus. I assume you mean computer virus. How do I manage my mind when I take a big loss or miss out on a big gains? I take it the exact same way as if I made a big win. And that might sound strange. If I make a big loss or I miss out on a big win, I stop trading. And I will close my computer if I need to, if it's that significant, and I will take a day off and I will go outside and I'll clear my mind with nature. Nature is my regrounding to focus on what matters. And it's really easy to then, for me, disregard this as a game, as it being less important than life, as my enjoyment of life being more important. Those are all ways that I combat FOMO or the sickening feeling in your stomach when you have a big loss. If you keep trading, and my experience with this comes from playing poker. Going on tilt playing poker is when you lose a hand, maybe you get bad beat or whatever it is, and you just keep going aggressive. That's a perfect example of not pumping the brakes and just having your foot on the gas pedal and not taking it off. And you are compounding your mistakes and making them worse and worse. And you'll see people do that in poker where they'll be going great. They'll be trading great or playing great for 4 hours in a tournament. They have one bad hand, it puts them on tilt, and next thing you know, in 20 minutes, they're out of the tournament. And that same psychological mindset can happen in trading as well. You have to have not only a stop loss on positions, but a stop loss on your emotions. And getting off the computer is that stop loss. You have to clear your mind. I can remember in Florida, after a big loss, I went to the beach, I sat on the beach and I looked out at the ocean and I thought about the universe. And that made me realize how insignificant that day's trading was, how much more important things there are out there. And it's the same thing with a big win. If I have a big win, I don't want to get lulled into a sense of complacency. I don't want to get over aggressive thinking that I know everything and can't lose. So if I have a big win, I'll take a lap as well, whether it's closing my computer and being done for the day, or just getting off the computer, resetting my emotions, calming down that hype and that excitement, and getting back to the game with a level head and a clean slate is how I try and approach every day. That's why another reason I like day trading and being all cash at the end of every day is a fresh, clean slate where the previous day means absolutely nothing to me. Can I show how to put stop losses on crypto monthly, weekly, and daily timeframes? I'll do that in an upcoming video. It's just using the higher lows on those uptrends. So for me right now, my GLD position, I'll use this as an example. So I entered GLD knowing, number one, gold had broken a couple months ago from a long-term 2-year equilibrium. So I have that as my foundation, knowing we're in a long-term bull move. From there, I entered here because the dollar was strong, the S&P 500 was at all-time highs, and I said to myself, if those two things are not going to knock down gold, what's going to knock down gold? So I entered here, and I put my stop under the low of consolidation. And I said to myself, okay, if we break the low of consolidation, I am out of this trade because gold's pulling back more, and it's now catching up to the reasons, dollar strong, market strong. If that doesn't happen and we see any kind of fear, gold is positioned really well to benefit from that. And so then we had the Iran news and the bull move, and now we have the coronavirus. But the bottom line is I made an entry, I had my stop level, and now I'm just walking up my stop. So I'm using the weekly time frame. If then scenario. If GLD is in a weekly uptrend, then I am holding my position. So the weekly time frame just established a higher low at 145.08. So previously my stop was under 136 and I'm now moving it up to under 145. And if we see follow through here and then another weekly higher low, I'll move up my stop level again. And that just ensures that I am going to profit on this trade no matter what. And I will have my cash back again. If we lose the weekly uptrend, I will zoom out, I'll look for a monthly higher low, and perhaps I'll try and re-enter at a lower price for a monthly higher low. So just as another example, if we're doing that with Bitcoin, you're looking at let's just use Ethereum. If we're doing Ethereum daily, as long as Ethereum is in a daily uptrend, I will hold my bullish position. So we just established a daily higher low. Let's say our previous one was 154.18. As soon as we see a bull move and establish a little new daily support level at 170, I can then move up my support level to that level. If we pull back, hold 170 and see continuation, I can move it up again. So walking up stop losses with the trend is how I view, and I do that on the short-term time frame as well. If I'm entering on an hourly oversold bounce, I can say to myself, I am in this hourly oversold bounce as long as the 5-minute uptrend is intact. Because when that 5-minute uptrend is lost, our hourly lower high is set. And I no longer want to be in that trade. So walking up stop losses with the trend is one way to manage winning positions. So I just talked about being in cash every day, but before I also talked about how long max you should hold a leveraged ETF. So again, I'm all cash at the end of the day 90% of the days or 95% of the days. Obviously not all the time, but it is segregating funds. The question is, do you segregate funds for swing trading in addition to day trading? Yes, I find that to be beneficial psychologically. I have a day trading account and I have an IRA account. That IRA is my swing trading account. So I treat it differently. And that can help you distinguish two different mindsets. If I'm normally a day trader and I have my swing position among all my day trading positions, it's very easy for me to be looking at that level or that profit or loss statement every single day. That's another thing. If you're looking at your profit and loss as you're waiting for a trade to play out, it can cause you to sway from your trade game plan. That's something that I've done many times where, I'll be in a trade game plan and I'll have an if-then scenario. If we're in an uptrend, then I'm going to stay in this position. And then I'll look at my profit and say, well, that's a 2-day maker. I'm going to lock that in. And that is me being influenced by the profit number to sway from a trading game plan and leaving money on the table. So separating them is ideal. A day trading account, a swing trading, or a long-term account, I definitely suggest that for organization. Thanks, Johnny5. Glad you like the Midas letter coverage. So I have developed a fear of losing, which makes me miss good moves. How would you deal with it? Again, it's all tied together. So if you have a secondary source of income, that fear of losing is subsided a bit because it's not the end of the world. For me, it was just getting numb to losing. Again, as a short-term trader, you have to lose a lot and you have to experience those losses and then experience recovering from them and knowing that you can make it back. And if you have the confidence to know that you can make your losses back, those losses are a lot less scary. It's just another little bump in the road and it's just one step back for your 2 steps forward that are going to come from it. So just like anything, it is having as much psychological cushion as you can by having those fear and scarcity mindsets blocked in any way you can. Secondary income is the best way in my opinion. And then having experience to have lived through it many times. I have lived through the big mistakes of not having a stop loss and watching my account go down significantly and then grinding for 2 months to try and make one losing trade loss back again. And as soon as you do that more and more, it's the same thing as, going to the dentist as a kid or going to the doctor and getting blood taken. It's the scariest thing ever when you're a kid and then by, young adult, you've done it enough. You know the routine. You've experienced these emotions before. I know this fear sitting in the dentist chair. I know what the result is going to be because I've done it before. And that experience leads to confidence that can help overcome fear. That being said, there are some people who are not meant to be traders. And I have had experience with some individuals in my life, friends, where I've just had to be like, I don't think this game is for you. And that is because of personality traits or if someone's really bad at decision making and can't sit there and decide what they want to eat for dinner, and that's a whole ordeal, you're probably not going to be able to make in the moment decisions trading stocks. Everybody's brains are different. It doesn't mean I'm better than you because I can trade stocks and your brain doesn't work this way. It just means that our brains are different. And just like society is structured for a certain analytical brain mindset to flourish in it, trading is structured for a certain mostly analytical brain type mindset to excel in. So that's where data comes into play. If you have a ton of experience over multiple years and it's still not clicking, I'm never going to tell someone keep trying. I'm going to tell someone it gets to a point where we need to be real with ourselves and say maybe this isn't for me. Just like all of us play sports growing up, we're not going to all expect to be professionals. There comes a point where we say, no, not good enough to go forward from here, probably better focusing on other things. And that's, again, something that I will be very real about. And you won't see a lot of financial gurus talking about that because that's essentially pushing away a target market. Here's someone who wants to learn how to trade who's really struggling, and I'm saying maybe trading's not for you, and it's the truth. There are a lot of people that trading is not for them. Some people recognize it very early on. Some people have to take their lumps and have multiple years before they can finally say, okay, I gave it my best. There's no shame in that whatsoever, but knowing when to stop is important, because if we do not know when to stop, it then becomes an addiction. This is gambling. We're releasing dopamine when we're clicking these buttons, and we have to be in control of that because it can get out of control. Not much of a chess player. I know how to play, but I don't play. Dan, can you please explain how you scale in size into a winning position, risking house money? So I'm not the kind of person who scales in on a winning trade. I'm more the kind of person who will scale out my initial position. So let's say I enter 1,000 shares and the price goes up 3%. I will sell half of my shares, put my stop at break even, and then allow that trade to just play out. That's my style of letting a winner play out longer as opposed to buying more. Now, if I'm looking, the only way that I would personally be buying more would be monthly uptrend, weekly uptrend, daily uptrend, and looking to buy a weekly high or low. So if I had a long-term stock portfolio right now and I had some cash on the side, I would be looking to enter on a weekly high or low and scaling in a bit of a position in current fear scenario. Got a titmouse bird on the window here banging open some sunflower seeds, distracting me. But the bottom line is I prefer to enter my trade, exit some of it, and then just let it run as opposed to adding to a winner. And that's just my style. The last thing that I want to do is be in a winning position, add to it, and then lose the uptrend. And next thing you know, that second position is now in the red, taking away the gains from my initial position. And that's just my personal preference. Wow, hour and a half already. No wonder my throat's getting raw. Trading psychology and technical analysis. What material do I recommend? So I have never read a book about trading. It's just not my learning style. But Trading in the Zone by Mark Douglas has high accolades from all of our traders in the chart guys. People really like that. So I would suggest Trading in the Zone. I would suggest, like I said, psychology books. I loved reading intro to psychology books in high school and college, whether it's, Carl Jung or Freud or industrial. See if you can find an industrial psychology textbook. Understanding psychology. I wouldn't look for a book. Trading in the Zone does a good job of psychology and trading in one, but I would be looking for sources of information just about psychology having nothing to do with trading as a bit of a base. And then, sources that are about technical analysis and trading. But treating them as two different things, because we want to understand psychology, not just with trading. We want to understand psychology with how the world works. I can't stress enough how many times in my life I have benefited from being able to observe my emotions and recognize emotions come up and being able to zoom out and not say, I am mad, and I need to find this will be a timely little meme here that's going to explain these thoughts better than I can. Let's see if I can find it real quick. Not gonna be able to find it. So what it is the person standing there and their thought is, I'm mad. And then the second person has 3 thought bubbles. The first is, I am recognizing that I am feeling that I am mad. And those 3 layers of separating yourself from that emotion are a game changer. If you are in the one level of recognition, I'm mad, you're going to react to that anger. Here it is. So I'm not good enough. and he's all bummed out. I notice that I'm having a thought that I'm not good enough. It's those layers of separation that allow you to analyze a situation before reacting to it. So whether it's, having anger or fear or whatever emotion it is, taking these extra couple of minutes to analyze before reacting means everything in trading, and it means everything in interacting with humans on a day-to-day basis. Anytime someone is not in control of their emotions and lashing out, it is because they are instantly reacting to those emotions and they are not noticing that they're having those emotions and that they're feeling this way because of those emotions. And again, this boils down to Psychology 101 and being able to understand how the brain works. And once you understand this concept, it makes life so much easier, and then that applies to trading as well. And shout out to Mind Owl. I have no idea where I got that from, but I remember saving it because I found it relevant. Presidential elections always influence the stock market. Do you use past elections to determine long-term trading opportunities? The way that I'm viewing it is that the market is going to stay the course if Trump is reelected, that the market is going to pull back at least initially, whether you can argue all you want, whether or not Democratic policies will have a long-term bullish or bearish impact on the market. I don't care. What I care about is that short term, it will be perceived by the market as bearish, and we will see capital leave the market if Warren or Bernie Sanders were to be elected. So those are my two mindsets, and that's the setup where I can say if then scenario. If the probability favors Trump staying president, then we're going to be looking for the market to be behaving similarly to how it has been recently. If the probability is favorable that Warren or Bernie Sanders is going to become president, then I will be looking bearish the market, I will be looking bullish the marijuana sector, and that is how I'm going to treat things. Swing trading generally is the best for beginners because it's slower. You don't have to be, time isn't as much of a factor. If you're day trading, you've got minutes to make a decision, whereas if you're swing trading, it could take days for things to play out. So learning just for ease, I would suggest swing trading for practice. Maggie Valley, that's westward. I assume you're having some springtime weather there as well. Do I write down my game plan for each setup I'm looking to play or keep it in my head? What does my notebook look like in a week of trading besides the whiteboard? So I personally, and this is an example where I am not doing what I tell others to do. And that's just 9.5 years of experience. I'm in my flow. I'm very comfortable and confident. I will keep a little piece of paper by my desk to just write a ticker down. But for me, it's easy enough to just, if I look at a chart and I say, okay, there's an equilibrium on Tesla that I'm going to look to play. All I have to do is write down Tesla. And 2 days from now or tomorrow when I get to the computer and I look at that, I will instantly recall and I'll be able to see the Tesla chart in my head as to why I wrote that down. But if you are newer to trading, take as many notes as possible. I used to, when I was, let's go back. So when I started the Chart Guys, it was difficult for me to trade and answer questions and live stream at the same time. That took over a year of an adjustment for me. And I had a small red year in 2000, I forget if it was 15 or 16, but when we started the Chart Guys, my trading suffered from my live streaming at the same time as trading. And I recognized, okay, I'm not used to this. I have to change things. So what I did was I lowered the amount of capital that I was putting at risk, and I laid out a game plan on every trade. And I made an Excel sheet where I had the date, the ticker, entry price, exit price, stop loss. That's my game plan right there. Then from there, how did it play out? Where did I sell? Any notes for the scenario to help me with memory recall? I could say, well, I was stopped out of this position, but S&P 500 had bear news on coronavirus hit at 10 a.m. Eastern. And that way, when I'm going to review that trade, I can say, okay, this happened, that's why this happened, and it helps me organize things. So now these days, no, all I'm doing is keeping track of my account totals. And when I see, start going down, then I know I need to change something. If things keep going up, then I just stay in my routine and I keep doing what I'm doing because my flow is working. If you are newer to trading, you have to find that flow and keeping track of your trades. Like again, someone can look at their historical data and say, I lose on oversold bounces. Stop trading oversold bounces. So the more data that you can keep on your trades and the trade game's setup, the better. And I work 7 days a week with stocks where I am always, on the weekend now these days, I'm doing videos for TheChartGuys members and I'm constantly seeing patterns and things, and I am always looking to the next day. And I'm setting up to say, okay, I've seen this pattern that I like and this pattern that I like. And if I look through 50 different charts, maybe 3 of those patterns stand out as ones that I like, but I know to write those tickers down and I know to focus on them on Monday. And being in the game that consistently is important. If I were taking a week off every other week, I would not be as good a trader because I would have these breaks that would break up my flow. And we have some old videos on the TheChartGuys where I talk with one of our members who is a psychologist about being in your flow and finding your flow. And that's so important. And that even goes back to animals, loving habits. When I was feeding the goats and the pigs, they wanted to be fed at the exact time in the exact same spot every day. And if that changed, if it's someone else doing it at a different time, at a different spot in their pen, they are going to be a little bit uneasy and a little bit stressed out. And if it's me doing the same thing that they're used to every time, they are just cruising in the flow. They're extremely happy and they know this routine and there's nothing out of the ordinary. Humans are the same. We are creatures of habit, and the more that we can establish a routine that works for us, the better. And then we can find that routine again. So if I have my routine, and let's say every morning I put on my music and I go get a coffee and I go feed the birds. And if I stop feeding the birds and I start to notice a break in my flow again, then I can just say, well, that's something I can easily go back to and try and fix the problem there. Resorting back to our mean, the mean being the average of what works for us. So obviously newer traders have to find that routine and that flow, but once you find it, it's just trying to make sure you don't deviate from it too significantly to throw you off. And that's why every time I travel, I will not say that I'm not going to trade, but I'm definitely going to trade way less because I don't have the same monitors, I don't have the same routine. And that's another aspect where running the TheChartGuys has benefited me without a doubt. Because if I were only trading for myself and by myself, I would not have the discipline to put in as much time and effort consistently as I do right now. So having TheChartGuys members looking to me to put out the morning whiteboard every morning, because that's what I do every morning and that's my routine, that keeps me more disciplined. It's like an extra layer of accountability that absolutely benefits from me. And when I say whiteboard, I'm just referring to what we the TheChartGuys do. I'm trying to pull it up. Every morning, how I establish my big picture of what the markets are doing. So every morning at 6:30, I'm sitting on my computer and I'm putting the morning news or the economic events. I'm doing the commodities levels. I'm doing our major players and laying out the game plan and our major stocks and some sectors and the MJ sector key levels. And what that forces me to do is not only write out things that are clearly standing out to me and I know to be watching for that day, but it forces me to look at everything. So if I were trading only by myself, maybe I would get lazy one morning and I'd wake up and I wouldn't look at what the financial sector and the biotech sector were doing because I only want to be trading Tesla, when in the end, that could have helped me. Basically, long story short is having added accountability is important, and that's where having an individual or a friend that you trade with, we have, we're trying to encourage the buddy system between TheChartGuys members to link up with other people and interact with each other to hold each other accountable. It's way more easy for me to be trading by myself and just skip my stop loss because I don't want to put a stop loss on this trade. If I have to tell somebody that I am not using a stop loss, they're going to say, what are you doing? And I'm going to be embarrassed to tell them that I'm not using a stop loss. So having added layers of accountability can keep our consistency and discipline on its toes, where otherwise it might get a little bit lazy. And I absolutely recognize that in myself as well. Without a doubt, running the Chart Guys has kept me more consistent. I got to wrap it up now. I'm going to do one more. We're going to end this. And then if you comment on the video on our YouTube channel, this will be there eventually, or you can do it now. I will randomly choose people for courses. I will contact you. And also, let me know if you're interested in our accountant contact with Rohit. Let's go with, I already answered that one. What's your opinion on averaging down? That's a good one. Especially when an investment has been going down for a long time. So, I don't like averaging down unless it's a part of the initial game plan. I scale into positions, which is technically averaging down, but that's part of my initial game plan, where I will say I am going to enter 3 positions on this drop. If we lose the weekly uptrend on the S&P 500, I will stop out of those positions. What I don't like is an investment based on fundamentals that does not go the direction you anticipate. There's no stop loss on the position, and you just continuously add to it. And I have learned through experience that's a great way to lose money in this market. We have to have a level where we sell. If we have no stop loss, our losses are infinite, up to 0. So we can't give ourselves that much exposure. And the worst thing that you can do is not recognize a prolonged downtrend and keep entering into it. So let's just use Bitcoin as an example because it's had such wild swings. Let's say on the all-time high run, I said to myself, as long as Bitcoin is in a weekly uptrend, I am going to be in a bullish position. We pulled back and set a weekly high or low at 10,400. And then we lost that weekly uptrend. So let's say, all right, fine, my long-term investment, I'm exiting. I'm taking some of my profit and exiting at 10,400. I will be back in a position when the weekly uptrend is regained again. So I'm now back to all cash. The weekly uptrend changes back to the bulls at 4,200. I'm now back in that position, $600 cheaper. The other scenario is not having that stop loss set and saying, I'm just going to enter on consolidation. So I have my position, I enter again at 9,000, I enter again at 6,000, I enter again at 4,000. Next thing you know, I am in a massive red position, and it's a big hole to try and climb out of. So you have to have a stop loss on even long-term positions, in my opinion, and scaling into them and averaging down is fine, but only if that is in your original game plan. For example, if I'm looking at IIPR and I want an entry after a big bull break on the daily, I want an entry for a daily high or low. I'm not going to anticipate, oh, I don't have my chart up. I'm sorry. I'm not going to anticipate that I'm going to nail the bottom and nail the daily high or low. I'm going to make one entry at $90. I'm going to make another entry at $87 and maybe another entry at $84. And then I'll say, okay, if we lose the daily uptrend after I've made those entries, I will exit those positions. Because the last thing I want to do is be scaling in to a name that's going to then be in a prolonged downtrend, because the psychological burden of that is every morning I have to wake up and look at my red portfolio. It's going to negatively impact my mood. If I'm not in control of my emotions, it's going to negatively impact the relationship I have with friends and family and potentially my partner that I'm living with. If I have to wake up every morning and look at a red position that just keeps going down because it's in a downtrend, and then I have to look at my wife and pretend everything's fine, it's a very fine line to walk. And again, aspects of trading will bleed into all aspects of our life. We cannot just compartmentalize it and say, yeah, this is just this thing I do, and then this is my life. It is a part of your life, and it is a big part of your life, and we have to manage that and how much influence it has on our life. So I appreciate everybody tuning in. This was good. we'll do this again. Maybe we'll do this once every month. I always like interacting with you all. And again, I always read the social media comments and respond to a bunch of the YouTube comments and the Twitter comments. So we appreciate those likes, retweets, follows, and comments. We're very active with that social media space. And comment. We'll pick some course winners. Have a good rest of your day. I got to get outside and enjoy this springtime winter weather. Do good things.